When we think of investing, we usually imagine stock markets, bonds, and modern banks. But the roots of investment systems stretch back thousands of years, long before Wall Street ever existed. Among the earliest civilizations to develop a sophisticated system of wealth management and investment was ancient China. Their methods were not just about making money. They were about balancing risk, preserving stability, and sustaining dynasties. The fascinating part is that many of the ideas we associate with modern finance, credit, diversification, public works funding, and long-term investment, were already being practiced in various forms in China centuries ago. The ancient Chinese understood that wealth could not just be hoarded, it had to be managed. Dynasties rose and fell not only because of armies and politics, but also because of how rulers and merchants handled money. From the earliest coinage to government bonds and trade guilds, the Chinese developed strategies to manage capital that in many ways resemble our current financial systems. The brilliance of their approach was that they tied wealth not only to profit, but to social stability and survival, ensuring that investment always served a greater purpose. Let us explore 11 forgotten financial strategies of ancient China and see how they created one of the world's earliest investment systems that still has lessons for us today. Before we continue, I wish to let you know that if you want to strategically leverage on ancient wealth wisdom to build and grow generational wealth, you can visit us at ancientwealthwisdom.com after watching this video to check out our best curated ancient wealth building wisdom resources. Or you can check the description and the first comment below for the link. Now, to our video, how the ancient Chinese created the first investment system. 1. The origins of money in ancient China. Investment begins with money, and China was one of the first civilizations to standardize coinage. During the Zhou dynasty, cowrie shells were initially used as a form of currency. Over time, these gave way to bronze coins shaped like knives and spades, each representing value and trust in trade. Standardized coinage allowed wealth to be exchanged, stored, and invested in ways that barter could not. Once money could be trusted and measured, it opened the door for lending, saving, and reinvesting resources. Farmers could borrow for seeds, traders could finance caravans, and rulers could build public projects. This was a critical turning point. Money was no longer just a tool of exchange, it became a foundation for growth. The very creation of stable coinage was, in essence, the birth of investment in China. 2. Agricultural investments and collective wealth. China's first and most important investment system was tied to agriculture. Since the majority of the population were farmers, wealth and survival depended on crops. To protect this foundation, rulers created systems where peasants invested their labor and resources collectively into farming. One of the most famous models was the well-field system during the Zhou dynasty, where land was divided into 9 plots. 8 were farmed by families, and 1 was farmed communally to support the state. This ensured that individual families gained from their own labor while also contributing to collective stability. In essence, this was an early form of taxation and reinvestment. The communal labor acted like dividends, sustaining the government, which in turn reinvested in military protection and infrastructure to safeguard the farmers' productivity. 3. State-controlled monopolies as investments. The Chinese dynasties often controlled critical industries as state monopolies. Salt, iron, and even alcohol production were placed under government control because they generated reliable revenue streams. By monopolizing these industries, the state created one of the earliest examples of structured investment portfolios. Salt, in particular, was a key commodity. By controlling salt distribution and levying taxes on it, dynasties ensured a steady income regardless of agricultural fluctuations. This revenue was reinvested into infrastructure, military campaigns, and civil services. These state monopolies were essentially government-backed investments. Instead of private corporations managing wealth, the emperor acted as the ultimate investor. diversifying the empire's income sources to protect against risk. 4. The invention of paper money and credit. One of China's greatest financial innovations was the invention of paper money during the Tang and Song dynasties. Initially, merchants used promissory notes to avoid carrying heavy coins. Over time, the government formalized this into the world's first paper currency. Paper money was revolutionary because it transformed wealth from physical metal into abstract trust. This shift enabled large-scale trade and investment, as merchants could now conduct business over long distances without the risk of transporting treasure. Alongside paper money came the development of credit. Merchants and moneylenders extended loans to traders who reinvested them into caravans or shipping expeditions. Credit allowed capital to multiply, laying the groundwork for sophisticated financial systems centuries before they appeared in Europe. 5. Silk Road trade as an investment network. The Silk Road was more than a trade route. It was an investment system spanning continents. Merchants pooled resources to fund caravans carrying silk, spices, jade, and porcelain across dangerous terrains to distant markets in Central Asia and the Middle East. This was a high-risk, high-reward model. Caravans could be attacked, goods could spoil, or political conflicts could disrupt routes. To manage risk, merchants often partnered, splitting costs and profits. This was essentially an ancient form of investment syndication. The Silk Road also showed early diversification principles. A caravan rarely carried only one product. It carried a portfolio of goods, ensuring that if one market failed, others might succeed. This mirrors modern investment diversification strategies. 6. Land ownership as long-term investment. In China, land was the ultimate store of wealth. Wealthy families invested in farmland, not just for immediate returns, but as a way to preserve prosperity across generations. Land provided food, income from tenants, and a stable legacy. Investing in land was seen as safer than trade, which was subject to volatility. Dynasties often measured wealth by land holdings, and political power was tied to control over agricultural estates. The stability of land investment allowed wealthy families to pass down wealth securely. It was not just an asset, but a strategy for generational wealth creation, one of the first examples of long-term financial planning. 7. Merchant guilds and collective investing. Merchants in ancient China organized into guilds, pooling resources to finance large ventures. These guilds functioned as both trade associations and investment networks, where members supported one another in business risks and opportunities. Guilds allowed for larger projects that no single merchant could fund alone. They also created shared rules, credit systems, and dispute resolution processes that built trust in collective ventures. This system resembles modern investment funds, where resources are pooled to maximize opportunities and minimize risks. The guilds ensured that wealth creation was a collaborative effort rather than purely individual. 8. The Confucian view of wealth. Confucian philosophy shaped China's investment culture profoundly. Confucius himself did not condemn wealth, but he warned against greed and misuse of money. Wealth was to be pursued ethically, with the goal of serving family and society. This cultural framework discouraged reckless speculation. Investments were seen not just as personal gain, but as moral responsibility. A wealthy man who neglected his duties to his clan or community was considered dishonorable. By aligning wealth creation with virtue, Confucianism created a financial system rooted in sustainability and stability rather than unchecked pursuit of profit. 9. Government bonds and war financing. During times of war, Chinese rulers raised funds through state-issued obligations, which functioned similarly to government bonds. Citizens and merchants lent money to the state, expecting repayment with interest once stability returned. This was a clever way to mobilize resources quickly without overtaxing the population. It spread the burden of war across society while giving investors a return on their contributions. Such bonds highlight how advanced the Chinese investment system was. They reveal an early understanding of debt instruments and the principle of raising capital through public trust. 10. Diversification across regions. China's vast territory offered natural opportunities for diversification. Merchants invested in goods from different provinces, tea from the south, silk from the east, horses from the north, to spread risk across climates and political conditions. This regional diversification ensured that wealth did not collapse when one crop failed or one trade route closed. Investors consciously spread their ventures, balancing stability with growth. This is essentially the same principle behind modern investment portfolios. Diversification, a cornerstone of financial planning today, was already being applied in ancient China through trade and agriculture. And 11. Wealth preservation through ancestral halls. Wealth in China was not just about the individual, but the family lineage. Ancestral halls served as centers of financial planning, where family resources were pooled, managed, and preserved across generations. These halls often acted as community banks, lending money to family members for business ventures or emergencies. Profits were reinvested into land, education, and rituals to honor ancestors, creating a cycle of both economic and cultural continuity. This approach ensured wealth was not squandered but preserved. It institutionalized family-based investment systems, teaching responsibility and stewardship long before the concept of trusts or family funds emerged in the West. Lessons from the ancient Chinese investment system. The ancient Chinese pioneered many of the core principles of modern investing: standardized currency, diversification, credit, long-term planning, and collective investment. But unlike purely profit-driven systems, theirs was rooted in social responsibility and balance. They understood that wealth could not exist in isolation. It had to serve the family, the community, and the state. By embedding morality into finance, they created a system that endured dynasties and shaped culture for centuries. The lesson is clear. The first investment system was not just about growing money, but about creating harmony between wealth and society. Modern economies could still learn from this balance of profit and responsibility that the ancient Chinese perfected. Thanks for watching, and don't forget to like, comment, and share this video if you found it insightful and helpful. And subscribe to this channel to continue discovering and learning ancient wisdom and secrets that you can leverage on to build generational wealth in today's world. Also, turn on the bell notification so you're always the first to be notified whenever a new video is uploaded here. And don't forget to visit us at ancientwealthwisdom.com to check out our best curated ancient wealth building secrets and wisdom resources. Or check the description and the first comment below for the link. See you in our other videos.